Well, Tuesday the 2nd of November was anticipated as being an important Reserve Bank board meeting, and no one was disappointed that this was in fact the case. In fact, it was so important that the Reserve Bank Governor gave a press conference at 4 o'clock following the 2:30 announcement of the decision. The main aspects of the decisions were, firstly, the board decided to discontinue the yield curve control policy, where it was buying April 2024 bonds at 0.1%, which is the current cash rate. Secondly, the clause that we've seen in previous statements that the board expected that the conditions for the first rate hike were unlikely to happen before 2024 was left out of the statement, and it was replaced by terms like it'll be some time before we move rates, but moving back to a more flexible approach to the timing. And thirdly, it was confirmed that the decision on quantitative easing will be made at the February 1 board meeting next year. So these two changes of policy I see as being a good time to change those policies. Yield curve targeting and setting a time frame for when the first rate hike would occur are unusually extreme policies. They're policies that are appropriate for the emergency setting of 2020, but now that the economy is recovering, inflation is rising, it's no longer necessary to have those extreme policies. And of course, yield curve control was always likely to run into some problems when you're trying to set the price with a limited quantity. So the price of that bond was being set by the Reserve Bank, but the quantity of the bond was fixed. So setting price and quantity is always a problem in freely operating markets. Well, did we get any more clues as to where they now think the timing of the first rate hike will be? The best way to look at that is how they've changed their forecasts. So the most important forecast change has been that the underlying inflation forecast for 2022 has been lifted from 1.75% to 2.25%, and for 2023 from 2.25% to 2.5%. So what that's saying is that the bank now believes that in the second half of 2023, underlying inflation will reach that 2.5%. And of course, we've been told that rates will not be increasing until the Reserve Bank is confident that inflation has hit the middle of the 2 to 3% target and is sustainably at that point. The second change was economic growth for 2022, and that was lifted from 4.25% to 5.5%, whereas the unemployment forecast was stayed at 4.25% by the end of 2022 and 4% by the end of 2023. Wages were also lifted in 2023 from 2.75% to 3%, but held firm at 2.5% in 2022. The Governor, in his associated statements, pointed out that he was still not confident that it would be before 2024 before rates would rise, but clearly those forecasts are now more in line with an expectation that rates will be higher in the second half of 2023. But has that caused Westpac to change their own forecasts? As you know, on the 18th of June, we forecasted the first rate hike would be at the February board meeting in 2023, well before the bank's guidance at the time of 2024. And we haven't changed that forecast since then. That's been despite what we've seen with higher inflation, volatile movements in the markets. And back in September, of course, the Reserve Bank Governor calling out forecasts that the rates would be rising any time before 2024. The reason why we expect that rates will be rising before the implied expectations by the Reserve Bank Governor are that we see underlying inflation lifting to 2.8% in 2022 and wages growth to 2.75%, while we see the unemployment rate falling to 3.8%. So compare that with the RBA. So 2.8% on inflation, they're at 2.25%. 3.8% on the unemployment rate, they're at 4.25%. So we have a more upbeat outlook for the economy and for inflation, and as a result, we're expecting that the Reserve Bank's forecasts are still too slow in terms of when we're likely to see the hike. But of course, this all contrasts with the market. And the markets have now got around 3 to 4 rate hikes in 2022. Now, the Reserve Bank Governor is quite dismissive of that. He points out that a key factor there is the lack of movement in wages. He sees wages as having quite a high inertia in Australia. And when we look back at the history of wages growth, that is certainly supported. And he points out the fact that his own liaison is still indicating in talking to businesses that wage pressures aren't particularly strong. He looks at globalisation, technology, and a general attitude of business to keep costs down. So the really key thing is that with wages only growing at 2.5 by the end of next year, that's not strong enough to give them enough confidence that any rise in inflation will be sustainable. So we've got a higher level of wages growth, a lower unemployment rate, and therefore a more likely profile for wages in 2023 that would support the concept that these higher inflation numbers are sustainable and the first rate hike will be necessary. Another important factor, of course, is where the market is seeing the peak in this cash rate cycle, around about 1.8% by the end of 2024. We think that's way too high. Our expected peak is only 1.25%, and we're deriving that from the outlook for household indebtedness. Given the huge lift in household debt in response to the very low interest rates and the surging housing market, not going to take too much of a rise in the RBA cash rate to really start to impact upon households. So we think that 1.8% from the market is just too high, and that's why we've got a flatter profile for the peak in that rate. And that, of course, is very important for the outlook for housing. So if the market was correct and there were 4 rate hikes next year, then our forecast that we'll see further increases in house prices in the first half of next year, a flattening out in the second half, and then falls in 2023 would have to be brought forward. Of course, the housing market would not respond well to a series of rate hikes as early as 2022. So there's a lot relying upon the difference between the RBA forecasts, our forecasts, and the market's forecasts. We feel pretty comfortable sitting in the middle at the moment. We think that the governor is underestimating the strength of wages growth. We accept that his insights into the fact that he can look at the rest of the world and feel more confident that wages growth in Australia is going to be lagging the rest of the world, pointing out that in the US, private sector wages growth up to nearly 5%, whereas our wage price index is 1.7, likely to lift to above 2% in the next reading, but still coming from a lower base. So one point that we do agree with the governor on is that the timing of the rate hikes will see Australia lagging. So we have the Fed raising rates for the first time in December next year, markets around about September, before we have the RBA raising rates in February. And we're very comfortable with that view, whereas of course the market has 4 rate hikes next year, and of course the Fed only priced for the first rate hike by September. So let me summarise that we're very pleased to see a movement towards a more normal approach to policy. The emergency settings are no longer required, and the policy towards setting rates is no longer necessary. But now it becomes a forecasting game, and we think the Reserve Bank's forecasts are still too cautious, and that's why we have the first rate hike in the first quarter of 2023 compared to the implied forecasts around the RBA's new forecast of late 2023. Thank you.